I'm looking at a few numericals that you can get here in the economic growth and the investment decision. The first numerical that you can get would be on Cobb-Douglas function, and you will be given three things. So we have three things with us. First is a function, the aggregate function that is comprised of labor, capital, and level of technology. In the first numerical, you can get something like where you have to calculate growth rate. You will be given the total factor productivity growth rate, which is in one of these Schweizer question 2%. Now then you would have given the labor cost accounts for 60% of total force. So 60% into labor growth rate and 40% into the capital investment rate. So that would give you the economic growth rate. So that is one numerical that is seen. Another numerical that is seen here is about when you are given just a few things based on the neoclassical model. So in the neoclassical model there is a numerical that says which says about total factors of production, labor force growth rate, and labor cost proportion of total factor cost. So here we define TFP growth rate by labor force growth rate, and whatever we get we add with the labor force growth rate. So we have the TFP growth and the labor cost as a proportion of total cost factor. These two terms with us. So these are the two numericals. I don't see any numericals other than that in the Schweizer book or in the curriculum. So you might get these two. So again, a quick revision. In both of the countries, you are looking at sustainable growth rate, the steady growth rate. So estimating steady growth rate by the neoclassical model, it would be theta upon 1 minus alpha plus delta L, or TFP growth rate upon labor cost proportion of total factor cost plus labor force growth rate. If you get an answer that is wild from 3-4-5%, then you must rethink and you might have done some mistake, and that is the best part. So in the steady state rate, the growth rate of productivity is the function of growth rate of technology and labor share of output. So labor cost is a proportion of total factors of production. In the steady rate, marginal product of capital MPK is equal to alpha y by k is constant, but marginal product is diminishing. So this was the neoclassical theory, and the other was the Cobb-Douglas function, which generally talks that the long-term growth rate of technology plus alpha into long-term growth plus 1 minus long-term growth rate. These are the two numerical that the chances you are going to get. The other is Taylor theorem, not much given into the Schweizer book, and that's where it becomes tricky. It's about how a central bank would change the rate based on various factors, and based on that you can find out what would be the interest rate, and that is again an interesting thing. So there are three types of things that central bank wants to control, and based on that, so this Taylor rule 3 becomes important, whether it depends on the appropriate policy. So these are a few typical things in the economics that you can get. The Taylor rate would be more towards the interest rate. The other here is the theories in economics. Other than that, in this part I don't see any anything that could stuck you except the arbitrage theory. The other thing that we were looking at before this one was something called the Fisher equation. So that is something again that you should take care of. So the Mundell-Fleming model of exchange rate evaluates the impact of monetary and fiscal policy on interest rate and consequences of exchange rate. Under monetary, we assume that output is fixed and monetary policy primarily affect inflation, which are an exchange rate. So that was the two policies and profit on carry trade. So there was one more numerical that I saw here. It was just before I move ahead, the Taylor exchange rate or the real exchange is equal to equilibrium exchange rate plus real interest rate minus real interest B minus A, and risk premium B minus A. This was something, but let me move to the Mundell-Fleming model. So Mundell-Fleming evaluates the impact of monetary and fiscal policy on interest rate and consequently on exchange rate. Change in inflation due to monetary are not explicitly modeled by Mundell-Fleming. So that was all. Although I guess I read somewhere that there have 3 accounts, and based on that you would see your currency move up and down. I think I lost it somewhere. So these are some of the theories. Just keep your mind open and you would be able to solve a lot of them the arbitrage type of question are more common to be seen. Hope this was useful for you. Thank you for listening.